5 ways car dealers can hurt your credit without telling you. You can walk into a dealership with great credit and walk out with a much weaker financial position, and most people don't even realize it happened. Because it's not always your credit score that gets hit, it's how the deal is structured behind the scenes.
Most buyers think dealerships only affect the price, but once you sign that credit authorization, they're shaping your entire financial profile.
So let's walk through 5 ways this happens without you being clearly told. Number 1, shotgunning the credit. You give permission to run your credit one time and suddenly it's sent to multiple lenders. Now you see multiple inquiries on your report.
To be fair, these are usually treated as one scoring event by FICO if they happen within a short window. But here's the problem.
If it's not controlled, it can spill outside that window or mix with other credit activity. Now you've got unnecessary hits on your credit. At number 2, marked up interest rates. This one doesn't show up as a credit score drop, but it absolutely affects your credit strength. Bank approves you at 6%. Dealer sells it to you at 8 or 9%.
Now your payment is higher, your total debt load is higher, and that affects future approvals because of debt-to-income ratio, refinancing options, and your overall risk profile.
It's not just about getting approved, it's about how the deal is built once you are approved. At number 3, extending the loan term. You ask for 60 months. They structure the deal at 72 or even 84. Why do they do this? Lower payment looks better to the customer.
But now you're in debt longer, a slower payoff, more interest, and a longer period where your credit is tied up.
That's not helping your financial position, it's stretching things out. At number 4, packing add-ons into the loan. This is one of the biggest ones. GAP, service contracts, protection packages, all rolled into your financing.
Now your loan balance is inflated, sometimes by thousands, which means higher debt relative to the vehicle, more negative equity risk for you.
And that affects your ability to trade, refinance, or get out of the loan early or cleanly. At number 5, yo-yo financing. This one is serious. You drive off the lot thinking the deal is done. Then you get a phone call. We need you to come back. Financing fell through.
Now the deal changes. A new rate, new terms, maybe even a new lender.
And behind the scenes, more credit activity, more applications, more confusion on your profile. So a big reality check. Let's be clear about something. Most of these don't drop your score overnight, but what they do is just as important. They weaken your overall credit position.
And that shows up later if you try to borrow any time soon after.
Dealerships aren't just selling cars. They're structuring financial deals. And if you're not controlling that structure, someone else certainly is.
So what do? Know when your credit is being pulled. Know what rate you actually qualified for by having your own pre-approval. Know what's being added into your loan.
And most importantly, don't ever rush the process. Because this is exactly where buyers lose money and don't even see it happening. So if you want to skip all of this, we handle the entire deal with our car buying service, start to finish, headache-free.
We get the real numbers, we structure the deal correctly, and we make sure nothing gets buried in your loan.
Follow the homework, guys, so dealers can't rip you off, because the more you know, the less they can take away from you. I'm Kevin Hunter, the homework guy. Don't get taken every time.